Hello, and welcome to this podcast for investors that focuses on the impact of the new revenue standard on the healthcare services sector. I'm Jeff Brickman, Senior Investor Liaison at the Financial Accounting Standards Board. Thanks for joining us. With me today are FASB Board Member Mark Siegel and FASB Senior Project Manager Mary Mazzella. We will provide a brief overview of the revenue model, along with some sector-specific impacts that we expect for the healthcare services sector. Throughout the discussion, we will have slides you can follow along with that will include a few examples that should illustrate some of the impacts we are anticipating. But first, before we begin, I'd like to remind everyone that the views expressed in this podcast are the personal views of the participants. Official positions of the FASB are reached only after extensive due process and deliberations. With that, let's get started. Mark, can you give a high-level overview of the new revenue model?
Sure, Jeff. I guess first, let me just set the stage by mentioning that this podcast is part of a series of industry-specific webcasts and podcasts to help investors know what to expect as public companies adopt the new revenue recognition rules next year at the latest. Some companies have, in fact, already adopted as of the third quarter 2017. To the extent you follow more than just healthcare companies, you probably want to check out www.fasb.org and click on the Investors link and look for the Educational Resources Available for Investors section to find archived webcasts and podcasts for other industries we've already covered. So, for example, we've previously recorded webcasts, including Q&As with executives from the A&D industry, as well as executives from the software and SaaS industries. As far as the new RevRec model goes, as you'll see on slide 2, the new revenue standard has an overarching framework to recognize revenue. It applies to nearly all revenue from contracts with customers, except for a few areas where there are other models in GAAP, like for insurance companies or leases or financial instruments. One goal, though, was to reduce, wherever we could, the industry-specific differences in revenue rules, because it's really not sustainable for the FASB to keep revenue rules up to date on a sector-by-sector basis, especially with new industries popping up all the time because of technology or other factors, and really the lines between industries blurring. It's important to note, too, that the new rules for GAAP revenue are generally converged with IFRS rules, so that most public companies around the globe will soon be following the same set of rules. However, it's definitely true that the impact of the standard will vary from industry to industry. The new standard includes 5 steps to recognize revenue, which are displayed on the screen. A company will evaluate its contract with the customer to make sure there is a substantive contract. It will then identify the promises it has made to the customer as part of that contract and which of those it should account for separately. The third step requires the determination of the overall consideration, which is really the purchase price, and whatever that company expects to receive for all those promises, including any estimates of what might be considered variable or contingent amounts. A company will then allocate that total amount of estimated consideration to each of the promises that have been made to the customer, and that's step 4. Finally, the last step is that it will recognize revenue either at a point in time or over time as the seller satisfies the promises that were made to the customer.
That's helpful, Mark. So, Mary, what are some of the impacts of the new revenue standard that we expect to see in the healthcare services sector?
Jeff, we wanted to highlight one significant area of change where we are anticipating for healthcare service providers on slide 3. And that area relates to a service provider's accounting for the provision for bad debts, or bad debt expense as some may call it. As background, today's GAAP requires healthcare service providers to record revenue using the billed amount for its services, even when the service provider does not expect to collect that amount. This might be the case for an uninsured patient. The service provider is also required to record a corresponding provision for bad debts. The provision for bad debts can be significant for some healthcare service providers because of uninsured patients or patients with high deductibles or high copays. Today, the service provider is also required to show the provision for bad debts as a separate line item on the face of the income statement to come to a net revenue amount. This grossed-up presentation is unique to the healthcare services sector. As Mark mentioned before, much of the industry-specific guidance, including this bad debt aspect of the guidance, will no longer apply when an entity adopts the new revenue standard. The new revenue standard requires an entity to recognize revenue in an amount that reflects the consideration the entity expects to be entitled to. In determining this amount, an entity must consider both explicit and implicit price concessions or discounts. Both explicit and implicit price concessions or discounts reduce the amount of revenue that will be recognized.
Can you further explain what you mean by an explicit price concession versus an implicit price concession?
Sure. As an example of an explicit price concession, consider a healthcare service provider that has a list price for a procedure of $1,000. Some insurance companies may have a negotiated rate of $800 with the healthcare service provider for that specific procedure. If a patient is insured by one of those insurance companies, the healthcare provider gives an explicit price concession or a discount to that customer of $200. So the amount of revenue to recognize would be the $800. Explicit price concessions today are included as contra revenue and net operating revenue before the bad debt provision. Implicit price concessions are handled the same way as explicit price concessions in the new standard. They reduce the amount of revenue to recognize. Implicit price concessions are not contractual price concessions like the $200 discount in my example. Instead, they involve situations in which an entity's business practice is to accept a lower amount for its goods or services. We expect implicit price concessions to be common in the healthcare services sector because some healthcare companies provide, or are required by law to provide, services regardless of the amount that will ultimately be collected. For example, an uninsured patient may only ultimately pay a small fraction of the normal price of the services. I should note that a charity care patient would not be receiving an implicit price concession because they typically do not pay any amount for the services provided, which means there would not be a substantive revenue contract to evaluate under the guidance. Going forward, for non-charity care patients, healthcare service providers will need to estimate the amount they ultimately expect to receive for the services provided, considering both explicit and implicit price concessions. That estimated amount is the amount that will be recognized as revenue. The revenue amounts may be adjusted in future periods if the service provider collects more or less than they originally estimated. This amount is required to be disclosed as out-of-period revenue if the adjustments occur in a different reporting period than when the healthcare services were performed. Because the service provider estimates the amount it will ultimately collect, it's possible that the company will not have significant amounts of bad debt expense. Bad debt expense on receivables would be recognized due to changes in the facts and circumstances about a patient's ability or intent to pay the estimated amount. For example, this likely will be the case when the healthcare service provider is informed that the patient declared bankruptcy or that the patient is no longer employed. As a change from the grossed-up presentation we discussed earlier, any provision for bad debts will be presented as an operating expense outside of revenue after the adoption of the new standard. As you may be thinking, healthcare service providers will need to exercise significant judgment to determine whether a change in its estimate is due to changes in patient-specific facts and circumstances resulting in bad debt expense.
Thanks, Mary. Those are good points to think about. In my experience, investors tend to key in on the areas of a company's financials where management uses significant judgment. Perhaps it would be helpful to walk us through an example of an implicit price concession.
Sure, Jeff. We've laid out an example on slide 4. Assume a hospital provides medical services in the emergency room to an uninsured patient. The hospital is required by law to provide medical service to all emergency room patients, and the patient does not qualify for any government subsidies and is not a charity care patient. The hospital typically charges $10,000 for the services provided, but based on the hospital's historical experience with discounts to similar customers, it estimates the customer will pay only $1,000. Based on these facts, the hospital would recognize $1,000 of revenue when it provides the emergency room services. It would not recognize $10,000 of revenue and $9,000 of bad debt expense like it would under today's GAAP.
Thanks, Mary. So based on that example, it seems like under both the old and new guidance, the net amount of revenue is the same. It's $1,000. So the difference today is that there's a gross revenue of $10,000 and bad debt of $9,000. And under the new guidance, there will be a revenue of $1,000. Is that correct? And will that be the same result in all situations?
Yes, that's correct. Based on the SEC filings that we've reviewed, some healthcare companies have disclosed that they do not expect a material difference in their results of operations as a result of the new standard. But it's worth looking at companies' disclosures to understand whether there has been a change and why.
Mary mentioned charity care. Mark, does the new revenue standard affect the healthcare service provider's accounting and disclosures for charity care patients?
So Jeff, I think that's an important point. The new revenue standard doesn't affect the guidance or disclosures at all related to charity care. Charity care still will not qualify for recognition as revenue. Healthcare service providers, they're going to have to continue to disclose their policy for providing charity care, as well as the level of charity care they're provided.
Thanks, Mark. I think investors are going to be happy to hear that the charity care disclosures will continue to be provided. So far, we've focused on implicit price concessions. But how should a healthcare service provider account for transactions in which it does not give an implicit price concession?
Okay, so let's walk through that on slide 5. As Mary mentioned earlier, implicit price concessions, those are going to be common in the healthcare services sector because some healthcare companies, they're required by law to provide services, whether or not the patient can pay for them. However, a healthcare service provider is not granting an implicit price concession in all cases when it doesn't receive the entire billed amount. For example, if a service provider is not required to accept all patients and determines that collection of substantially all of the consideration is probable, then amounts that ultimately are not collected may be due to credit risk that was present in the patient contracts.
It seems like each company will need to evaluate its specific facts and circumstances to determine whether to record an adjustment to revenue or bad debt expense. Is there anything else you can add to help with this point?
Yeah, so Jeff, like you pointed out, this is going to be an area where it will depend on the healthcare services provider's specific facts and circumstances. So let me walk through an example on slide 6 that will hopefully illustrate when the service provider has not granted an implicit price concession, and therefore it's appropriate for the service provider to record bad debt expense. So in this example, the hospital provides services to a patient for cosmetic surgery, which isn't covered by insurance. The hospital assesses whether the customer can pay the $50,000 for the services. Now, based on this assessment, it concludes that it's probable that the customer will pay substantially all of what they owe for the services. So this conclusion also implies that the hospital is not granting an implicit price concession to the patient. Now, however, it's important to point out that this assessment is really only designed to determine whether collection is probable, and the hospital knows that its historical experience with similar patients suggests that 2% of the patients will not pay. This is a result of the general credit risk of customers. So based on these facts, the hospital will record the full $50,000 as revenue for the services provided because it has not granted an implicit price concession for that contract, and it has determined that collectability is probable. The hospital will then assess receivables for impairment and record bad debt expense as a result of that.
Okay, Mark. I know the new standard also includes disclosure requirements that are different than those that healthcare service providers apply under today's GAAP. Can you tell us about the new standard's disclosures and when companies will have to transition to this new standard?
Yeah, so that's right, Jeff. The new disclosure requirements are the same for companies across industries. So the industry-specific disclosures that exist today that require a healthcare entity to disclose information about bad debts by major payer source of revenue and how the major payer source is identified, those unfortunately will no longer be required after the adoption of the new standard. Now, however, as I mentioned before, healthcare companies will still need to provide the charity care disclosures. Also, the new standard includes a disclosure package, as shown on slide 7, that was developed with a lot of input from investors to provide more information about a company's contracts and revenue that it has recognized, included disaggregated or broken down information about the revenue. The disclosures will also include information about significant judgments and estimates, how and why an entity recognizes revenue, and information about any revenue that was recorded in this period that relates to a different period or a prior period before. So you also asked about transition. So slide 8 illustrates the transition requirements. Public companies are required to adopt the new requirements in fiscal year 2018, beginning with the first quarter. The standard includes 2 transition methods for companies to apply. But regardless of the transition approach that a company takes, it will have to provide some degree of comparative information to its investors. So you will be able to understand the impact of the new standard on a company's revenue during the first 4 quarters of the year that the standard is adopted. investors should keep an eye out for the 10-Ks and 10-Qs issued before the adoption of the new standard for disclosures about the transition method a company plans to use and the expected impacts of the standard.
Thanks, Mark. That's helpful. It's important for investors to keep in mind that today we've discussed some of the bigger changes we've heard about, but it's possible there are other changes for a particular healthcare service provider. So there's no substitute for understanding a company's disclosures about the impact of the new standard. To wrap up this podcast, I'd like to take a moment to discuss some of the key takeaways and observations from this conversation. First, bad debt expense will no longer be a separate line item on the face of the income statement to come to net revenue. In many cases, revenue under the new standard will already include the amounts the company does not expect to collect, so the provision for bad debts likely will significantly decrease. Second, any provision for bad debt as a result of patient-specific credit deterioration will be recorded as an operating expense rather than as a contra revenue. Third, I also want to reiterate that a healthcare service provider will need to exercise significant judgment to determine whether it is granting an implicit price concession or accepting some amount of general credit risk, and whether subsequent changes in estimates should be recorded as bad debt expense or revenue. The new revenue standard requires a company to disclose information about its significant judgments and estimates. So hopefully healthcare companies will provide this additional useful information, which should include how those judgments and estimates change over time. Thanks for joining us for this podcast, and we hope you have found it helpful. Additional information, including all of our contact info and further details on the new revenue standard, can be found at www.fasb.org.